Hello and welcome to PS Perspectives. I'm Colin Callahan, Product Specialist here at DoubleLine, and I have the distinct pleasure of being joined by Monica Erickson, Portfolio Manager of our U.S. Investment Grade Credit team here at DoubleLine. Monica has over 30 years of industry experience and has been working alongside our Chief Investment Officer, Jeffrey Gunlock, for over 15 years. So welcome, Monica.
Thank you so much for having me, Colin.
Great. So it has been a challenging year for fixed income, and investment grade credit has participated in that drawdown. So looking at the backdrop for 2022, we've had a hawkish Federal Reserve that's been tightening financial conditions and raising rates to combat decades-high inflation, really on top of slowing economic growth. And so before we get into Monica's 2023 outlook for investment grade credit, we thought it would make sense to touch on what's happened thus far in 2022.
Right. Well, thank you. Like you said, it has been a very tough year for fixed income across the board, and specifically a very tough year for any kind of duration in fixed income. The investment grade space year to date, as of today, is down about 13%. About 1% of that has to do with the actual move in spreads within investment grade, and the rest of it has to do with the move in the treasury market. So really, the returns have been negatively impacted by the dramatic rise in treasury rates this year. We started seeing the beginning of it in March, and the Fed has raised rates 5 times, I believe, since March, the fastest the Fed has ever raised rates historically. And so any asset class within fixed income that has any kind of duration, i.e. exposure, sensitivity to movements in rates, has been impacted negatively this year.
Yeah, and it really has been a historically down year for fixed income. And while DoubleLine has been underweight investment grade credit, in our fixed income asset allocation strategies, relative to our peer group and relative to the benchmark, a trade that's really worked. It's important really to look forward and think about how fundamentals could affect investment grade credit's returns in 2023. So first, investment grade credit just comes on the back of a strong earnings season. They have healthy balance sheets. So the outlook looks okay heading into 2023. Given the backdrop of higher rates, how do you expect investment grade corporates to perform, in terms of their interest coverage going into next year?
Well, I think there's 2 different things that we look at to determine the whether an asset class is attractive or not. So one of it is valuation, and the other is really fundamentals. And I think from a fundamental standpoint, which is what you were asking about, we're going into 2023 with fairly strong balance sheets. Interest coverage is close to all-time highs. Leverage has come off the peaks. The average leverage within the investment grade space is at 3 times, meaning that companies have about 3 times more debt than they have cash flow. It would only take them 3 years to pay off all of the debt if they wanted to do that. Interest coverage stands at about 15 times, so they have 15 times more cash flow than they do have interest expense on any given year. So those metrics look very strong. Then the other part of the equation is looking at valuation. And valuations right now, I would say, are just kind of average. We're at about 125 basis points over the equivalent treasury, which is what we look at to see whether we are being compensated for the extra risk that we're taking when we go and buy a credit as opposed to a treasury security. Historically, we're about average in terms of where credits, where spreads are right now.
Okay, great. So another measure of fundamentals where we like to look at kind of the health of the investment grade market is upgrades to downgrades. So how does that look right now and kind of going forward into 2023 within investment grade credit?
Right, so we're still seeing positive trends there. This year we've seen about 3 times more upgrades from high yield into investment grade than we have seen downgrades from investment grade into high yield. Going into 2023, the expectations are for even a more favorable outlook there. The estimates are for about 8 times more upgrades from high yield into investment grade than there are from investment grade into high yield. However, that is a backward-looking kind of data point, and the market is always forward-looking. And I still think it is important to pay attention to where upgrades and downgrades are going, but we really pay attention more to kind of the valuation that the market is giving us and really where the fundamentals are. And like I said before, I think both of those are looking attractive right now.
Okay, great. So yeah, we do try to take a holistic approach when looking at the investment grade market. And right now, heading into 2023, DoubleLine does find that there are other areas within credit that are offering better relative value, so better return per unit of risk. However, within the investment grade market, looking out to 2023, what areas are you favoring? Are your team planning to maybe overweight going into next year?
Yeah, and I'd like to mention that we did do, one of the concerns I think investors have is that, rates are higher, right? And companies still need to finance a new plant or refinance debt. And one of the questions that's out there is what is going to happen to companies when they need to access the market and access it at these higher rates. So we have an extensive analyst team here. They did a deep dive into the credits that we own and helped us understand really where the risks are there. And overall, what we found is that in the investment grade space, there is not a lot of refinancing risk and not a lot of expectations for higher interest costs that might be detrimental to being able to service those. However, there are certain sectors I think that are at risk and other sectors that are less at risk and actually could benefit from this. Banks tend to be one of the sectors. I think we've been overweight the banks this year. We continue to like the banks. They offer better relative value than the equivalent rated industrial name, meaning that they have a higher spread. Historically, they've traded at least in line and sometimes tight to their equivalent industrial. And one of the reasons why the banks are trading wide right now is because of the technicals in the market, where number one, there's been more issuance within banks this year. And secondarily, banks tend to be more liquid, and with the outflows that we've seen, investors have been able to sell the banks where they haven't necessarily sold other securities. So we think that this technical backdrop has created an opportunity for us to continue to be overweight the banks. Now, like I was saying, we did do a deep dive into the credits that we own to try to determine where the risks are. And there are 2 sectors. They tend to be smaller sectors within the investment grade space. But however, the business development corporates tend to have higher refinancing risk, and also their underlying assets are more at risk. So we have been reducing our exposure in that sector. And also the aircraft lessors have a lot of exposure to refinancing risk, and we've been reducing our weights there.
Great. Well, thank you, Monica, for giving your thoughts on 2023 and investment grade credit and our underweights and overweights. We look forward to having you back on the show and appreciate you being here.
Great. Thanks for having me, Colin.